As we said in our previous lesson, the indirect method is much more widely used than the direct method. Under the indirect method, net income is converted to cash flow by making adjustments for transactions that have an impact on net income but do not have an immediate cash effect. Such adjustments comprise the elimination of non-cash expenses and changes in balance sheet accounts deriving from the application of accrual accounting. The starting point for the calculation of the indirect cash flow can be net income or EBITDA. And of course, if we start from EBITDA, we don't have to worry about non-cash items such as D&A and deferred taxes. Let's do the following. We can go through the calculation of an indirect cash flow. We will start from EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, right? So we'll have to consider only expenses that have been omitted but have a cash impact. In this case, these are interest expenses and taxes. We are omitting D&A on purpose, as it is a non-cash expense. Then we will calculate the movements arising from the three working capital components: accounts receivable, inventory, and trade payables. If the firm owns other assets or liabilities that are not common enough to have their own category, it will most likely group them in a generic category called other assets or other liabilities. For example, some firms classify their prepaid expenses as other assets. We will have to calculate the cash impact of these other assets and other liabilities. Okay, perfect. The sum of all cash movements we have here will give us the company's operating cash flow. Then we will have the calculation of cash flow from investing activities. This part of the cash flow statement shows us whether the firm made money from investments in the financial markets or from other companies it owns. In addition, the cash flow from investing activities comprises investments in long-term assets, such as property, plant, and equipment. The amount we see here contains the company's expenditure for property, plant, and equipment. As we said earlier, the third type of cash flows a firm can have derive from financing activities. The two sources of cash for financing activities are borrowing and equity investments. We can calculate cash flow from financing activities by using the following equation: cash received from issuing stock, or debt minus cash paid as dividends and repayment of debt. So that's why here we see cash flow from issuing stock, cash flow for the repayment of debt, and cash flow from the payment of dividends. Even though interest expenses are closely related to financing activities, they are not included in this section of the cash flow statement. Interest expenses deriving from debt are part of a company's cash flow from operating activities. And again, similar to what we saw for the direct method, net cash flow is equal to the sum of the three types of cash flows. This is how we calculate a company's cash flow using the indirect method. In our next lesson, we'll show you how all these operations are done in practice.